One of the things that I believe is so important to you becoming a better investor in the future is all of the technology, all of the great ideas that have been developed certainly over my almost 60 years of exposure to the investment process. And I have said it over and over again that investing has never been more efficient. There's never been greater diversification possible with small investors or large. There's never been the tax efficiencies that we have today, whether it's because of exchange traded funds or because of Roth IRAs and Roth 401ks. I'm not going to say it's a miracle, but I can tell you this, that what we have today to choose from as a way to invest is 1,000 times better than what I had when I was getting started in the 1960s. And today, Chris and I had the opportunity to sit down with somebody who has been in some ways as cutting edge as far as making things easier and easier for you as what John Bogle did in the mid 70s. I'm sure because so many people are trying to do similar kinds of things that it's not going to be viewed as radical. But what it does is as meaningful. And that is that Brian Barnes, kind of a young guy, starts right almost right out of college to change the world and changing the world he is. And Chris, I would really appreciate, because we didn't really in the interview with Brian, we didn't talk about how we use the M1 products or recommend people or urge people or educate people about all those things we're trying to do. But we didn't talk about really why M1 is so important to us. And before we get started with this interview, could you just share a little of that so people who are coming for the first time to this topic will understand why we think it's important?
Certainly. This is a follow-up to the M1 Finance podcast and YouTube video you and I did about a month ago, where we mentioned that the CEO, Brian Barnes, was available to us for an interview. And we asked for listener questions, and we've got many of those in this interview. We didn't get to all of them. But in that podcast and YouTube video, we showed how you can use M1 Finance to set up one of our sound investing portfolios simply by using one of the Pi shortcuts that we've created. And there are, as far as I can tell, really no easier ways, I think, as a buy and hold investor to pick a portfolio, to set it up, and then have your contributions automated and automatically nudge you back to the desired allocation that you want. Really, Brian and team at M1 built this for buy and hold investors. And that's what we're advocating. And so M1 is really interesting from that standpoint because we philosophically aligned around the goals and the objectives very early on. And they have an affiliate program, which we openly disclose. There is a certain amount of money that comes back to us if somebody signs up through one of our affiliate links or uses our pies, and we appreciate that. But we also very much want to maintain neutrality and not have a conflict of interest. And I think both you and I would say that as much as it's nice to have some funding come into the foundation, it doesn't color our opinions about M1 or other brokerage firms. So it's, I think, a really interesting interview because he talks about that. He talks about why he created it and what the platform offers to a buy and hold investor and why that's important.
And I have to ask because it was, for me, it was great fun to talk with him, partly because I love stories of young people working hard and working smart and creating things that are likely going to change the world. It makes me wish I, in fact, could be young again. And with what we know today, what a difference one could make. But were there any surprises to you that people should be kind of looking for that? Might get by one if you weren't alerted to something that was pretty important.
Well, I was pleasantly surprised to see that as the company has grown, Brian hasn't become distracted by trying to appeal to speculators or day traders or other things. And I was really surprised by the discussion we have about their target date pies and how those can be much more tax efficient in a taxable account. So, somebody interested in pursuing one of the two fund for life strategies that I've advocated in a taxable account, I think would find that part of the conversation really interesting. Yeah, it was a good interview. Not surprisingly, he's very well practiced as a CEO. He knows how to do this stuff in his sleep, probably, but it was fun.
Well, we had fun. Now we hope that you have some fun and you learn more about this product. And because it is new, you might want to start small just to get a feel for it. And as Chris had just mentioned, this is not for traders. I find the people who are not as happy with M1 are people who are trying to get in and out, if not the same day, a day apart, and it's just not built to support that. It's built to support long-term investors. So I hope one, that you will enjoy it, two, you will learn something, and three, it will generate more questions because Brian has offered to come back if we have something that we need to talk with him about, and talk with him we will. Thanks as always for being here with us. Well, this is going to be great fun. I will tell you that I'm actually a little bit speechless because when I figured that this young fellow, Brian Barnes, our guest today, he graduates from Stanford in 2012, and by 2015 he's already set the world on fire. Well, maybe it didn't feel like that, Brian, but
Felt
but
like there were fires going on at all times.
I'll bet you had a
Yeah.
few. But he creates M1, and I'll tell you, I don't know if it started on a kitchen table or not, but we would really love to hear that story about how did this thing happen, because it is something really very different than what other people are doing.
Yeah, absolutely. So, starts when I was relatively young. I was just introduced to investing at quite a young age. That my dad, managed his own stock portfolio, and me probably just trying to spend time with that and glean from him, and be the proactive son, would sit in his office and learn from him on some of the things that he was doing. And it always geared towards sort of the value investing mindset of, sort of Graham Dodd, Warren Buffett, of you're trying to find out what a company's worth, you're trying to calculate the intrinsic value, you're buying it at a discount and hoping that that investment compounds over time. So just by virtue of that, I became a personal finance nerd from quite the young age. Did that, middle school, high school, into college. Did a little bit of work prior to starting M1, but really got to a place where I was managing my own money and I was using a trading brokerage to enact what I felt was my investment portfolio. And I had a investment portfolio that I wanted to maintain. I had incremental cash coming with my paycheck every 2 weeks and was really using an Excel document to say, hey, I want to split up my allocation in these percentage fashions, have it funneled down to that, and it really just using an Excel document sort of automated, or it calculated all the trades that I needed to make, but never worked well because there wasn't fractional shares at this period in time. And so M1 was really trying to automate what I had been doing in my personal finance and saying, I want to think of my stocks, my investments more in the portfolio context and visualize it as a percentage of the whole, and really set, make the decisions of how I wanted to invest relatively infrequently and then have software take over and do the mundane things of putting it to work according to my allocation. And so 2015, you know, the online brokerages, there were Robinhood had just announced, the robo-advisors had just come onto the scene, and M1 was really trying to say, we can bring the automation of the robo-advisors, make it very easy to deploy money, but really have it be customized to your heart's content and say all of your money can go into the exact portfolio that you want. And so it has been 9 years, and we've just been chipping away at both that core issue and then expanding over time.
So what I hear in there, Brian, is, and you didn't go into the detail, but I can kind of imagine it. You know, you get a new deposit that's coming in, and you want to maintain your portfolio allocation, and you got to figure out all these different buys and sells, and it's, you know, a little bit of money into this one, a little more into that one because it's gone up or it's gone down, and so effectively, you were trying to automate that, right? You were trying to make it so instead of having to run the Excel spreadsheet, it would just happen for you.
Yeah, exactly. And it was trying to allow for doing things that just were really, really tough in the commission brokerage realm. So, someone gets 500, $1,000, every, 2 weeks, month, or whatever that they want to put into their investments. In the commission world, this was at a time when people were charging $10 a trade. So every time you clicked a mouse button, you'd get a $10 trade, which was not as a penny pincher, it was not the most fun thing to hit the mouse button. And then the math would never work out all that well. That, the second that you wanted to be diversified across 5, 10, 20 positions, you know, 500 or $1,000 doesn't go into 20 positions all that well. It would have you trying to buy 1.827 shares of something. And so you'd either have to round down or round up. And so it just became a very manual and costly activity to do what I thought was relatively basic, which is own a investment portfolio that I wanted to in the proportion to which I wanted it. And so M1 was really trying to, automate that process and sort of taking the perspective that people do have a perspective. They earn their money, they care about their money, they use commission brokerages to maintain an investment portfolio, they read the Wall Street Journal, they watch CNBC, so they have a perspective of what they think will take place in the world, where they want to invest, how they want to allocate it, their funds. And it was just very, very cumbersome to do it. Not only the processes, but then also just the interfaces felt pretty archaic and outdated at that time. And so it was really trying to say, how can we simplify this, reduce this, make it much more about portfolio management, and then automate the mundane tasks, and let the individual do what's more interesting, which is deciding the investment allocation and doing the research on what they want to own.
The partial shares. Obviously, regular mutual funds have been using partial shares as a way to buy or sell for 50, 60, 70 years or more. Uh, that wasn't the case with ETFs. You were early on. In fact, even today, a lot of people do not allow trading of partial shares. What's the deal with the partial shares? How are you able to do that and other people are not?
Yeah, so it's when we did it, it was one of these head scratchy things because, as you mentioned, mutual funds did it. And then truthfully, most brokerages were doing it in dividend reinvestment programs. And so, if you had a drip set up on either your entire portfolio, your investment, there's a chance that you would get 0.628 shares of something, upon the dividend rather than the cash outlay. And so we looked at it and said, it's possible. Why don't people allow it? And really what you have to do is you just have to account for it in the background, and someone has to own sort of the residual amount. And so we sort of said, M1, we can own between 0 and 1 share of the entire market. It's not that expensive to do. And what that allows us to do is have sort of, you sum up all the, shares of security A and you get to, an amount 0.5. We hold the extra 0.5 in just our firm name. The it's a weird aspect of it's actually not that difficult to do on the accounting perspective. What it causes is just a massive amounts of transactions. And so, the fact in M1, it doesn't matter whether you have $100 on the platform or 10 million on the platform, you deploy money, it goes to work the same way. And so if someone allocates $200 and they have a portfolio of 30 positions, that could kick off 30 transactions. And in the, Ameritrade, E-Trade, Fidelity, Schwab world, they just weren't built for that amount of transactions on that small dollar figure. And it got to a point where M1 at one period in time when E-Trade was still public, we had, I think, like 100,000 users, and we were doing more trades than they were doing on a day-to-day basis. And so really what we just had to do is build a very robust system to be able to process that amount of information and still be, fast to the end consumer. On the back end, it's actually a relatively straightforward accounting mechanism. Maybe to the short answer of why others don't do it, it's because their technology is archaic and old. And so, it really was by virtue of starting in 2015, being able to use the latest and greatest in technology and, use the technology that these big tech players were using for just scaled consumer applications that were doing, you know, hundreds of millions of people, billions of people, number of transactions each day. That's really what allowed for the infrastructure for us to support the amount of transactions that people were doing on the fractional share basis.
So when I hear you describe the way you came about the problem that led to creating the company, it sounds to me like you were a bit of a buy and hold investor. You had a portfolio, an allocation that you were thinking of that you wanted to maintain with additional contributions. Is that who M1 is best suited for? And if not, who is M1 Finance best suited for? And I guess a related question, Paul brought this up, is do you have any advisors using M1 to manage people's money, or is it still all retail investors?
Yep. So we definitely gear towards buy and hold, and we differentiate pretty significantly between trading and investing, and we sort of say, both start with the same action of you are buying security A, but really your hold time determines why you're doing it. And if you're buying at 10 a.m. to sell at 2 p.m., you're just playing the noise in the market. You're trying, what a stock does in any given day, it bounces up and down. Why did this go up 2%? Why did it go down 2%? Like, truthfully, nobody knows. And it's, we're just matching supply and demand at that period in time. Versus making an investment, what you're trying to do is actually buy ownership in that underlying instrument. And so if it's a individual stock, you are trying to buy ownership in that company. And what you do as an owner is you get rewarded based on how that company performs over periods of time. And so, you move from, I want the stock ticker to bounce up and down, to I want the company to perform well. And it just, it's a completely different mindset of, are you trading or are you investing? And so M1 is, we're truthfully like a terrible trading platform. We trade twice a day, and it's really just to deploy your money. And we're trying to say, if you are buying something, you should be holding it for months, years, if not decades. And really, when you sell something 7 years from now, if you bought it Tuesday at 10 a.m. versus Tuesday at 1 p.m., like, it should be completely irrelevant. What really matters is, are you maintaining a investment portfolio of things that you know and understand in a diversified portfolio? Are you keeping costs low? And are you, systematically performing good habits like, rebalancing on occasion, systematically adding to things that, underperform, and, potentially pulling away from things that overperform to maintain your, portfolio or asset allocation. And so for us, it's really geared towards the person who says, I'm a long-term investor. I buy things for the underlying ownership rather than the ticker stock price movement. And I'm trying to maintain an investment portfolio and systematically contribute to it over long periods of time. And, what I would say is, like, that's very much geared towards our invest product, which is our first product and still our anchor product. But, I'd say we carry a lot of the same principles of prudent financial management across our other suite of products, whether that's earn, spend, or borrow. On the financial advisor stuff, we do have a handful of people that use the financial advisors. The predominant use case is direct to retail. We have been pinged all the time to set up the account, and it's on our docket of, we have infinitely more good ideas than we can actually get through. And so, it's always in the priority queue, but, we try to figure out when we can attack it. So for me, the advisor question is always a question of when, not if, but it's not something that we're currently working on to support advisors, just given the demand that we have in retail.
Which triggers the question, what is higher up the ladder in terms of things that you'd like to do next in order to meet the greater needs?
Yeah, it's a fantastic question. I'll start with where we've come from and what we've built and where that supports. So, we started on the investing perspective and built the automated free portfolio management. We then sort of said we just want to be a general financial institution and say M1 is where you go to manage your money or your finances, and your financial needs are broad. You need to be able to earn and transact money. You need to be able to borrow money. There's like a whole bunch of diverse needs. And we sort of took underlying principles of unearned, how can we help you earn the most? And how can we help you, as you have cash, earn the most on your cash? On the invest, it's how can you be allocated to the exact portfolio that you want in exact proportion to what you want as easy as possible. On spend, how can we make that as simple as possible and reward you as much as we possibly can with cash back? Borrow, it's how can we give you the lowest rates and the most flexible terms? And so we built a lot of these tools just trying to attack the first principles of what is smart financial management across each one of these disciplines. And then we've built an automation layer so that anytime a dollar comes into the platform, it's just routed towards where it could be best used. So that's sort of the product set. We then went 2020 and 2021 was fintech mania. We raised a lot of money, and we really focus on vertical integration. And so in the brokerage realm, that's called self-clearing. And so we built all the infrastructure to support that. And really what that the end result to the customer shouldn't be much. It should act, very similar, but what it allows us to do is just keep costs incredibly low and allow us to innovate on product a lot faster. So, that was a monumental effort. We built a lot. I went and I purchased a small bank, and we're using that bank to support a lot of our different products. And so that was a huge effort in itself. We built the technology there. And so what I'd say is we were using partners to support all of our products. We built all the pipes and plumbing, and we talked about it as moving into our forever home. And so, this is the final, like regulated entities and infrastructure that we'll ever need to build. Now I would say we have the pipes and plumbing, and it really gets to call it like a layer of intelligence built into the platform. And so how can we offer insights and guidance on so that in each vertical very intelligently across the various domains? It sort of takes the holistic nature into account. And so you were asking about, do we want to offer it to advisors? I think our ideal scenario is M1 should feel like you have an advisor in your pocket that is your sort of digital CFO, so to speak. And so that is what is high on the priority list and things that we're chipping away at.
Which of course is where we come in terms of us being thrilled with M1, is that we have these portfolios that we are teachers, we are not managers, but we share these portfolios, these pies, as you call them, with people who want to use M1, and that is creating something of a what would be similar to a robo-advised portfolio, but do you consider yourself a robo-advised source?
I don't think we meet the like standard definition. And, I think even if we like the robo-advisor, there's sort of two components of it. I think we fit very heavily in that robo component of how can you set up instructions and then how can we automate that so you can do relatively complex things with efficiency? How with 3 button clicks can you do what would take you 12 button clicks every 2 weeks for the next year? And so we're like the robo and automation component we absolutely fit into. We don't view ourselves as advisors, and so we're not making investment recommendations. We view ourselves very much as we are the tool and the platform to support what you want to do with your money. And what this like proverbial you or whatever our client is, to me, like it runs the spectrum of there are people who are not interested in it and don't have the financial education, and so they want someone to tell like them what to do. There's people who are geek out on it so much that they want to fine tune every single dial and optimize it down to the penny. And then there are people in between where it's I want the form of education where this is something that is important to my life. I want to get good at, I want to learn, but I also I want guidance as I do this. I don't want to jump into the deep end immediately. And so, the nice thing is M1 really does work for anybody who falls on that spectrum from the I'm not sure what to do and I just want, an off-the-shelf solution to I want to customize it to my heart's content, or I want a combination of both. And it allows for people to do, what sort of like you do the hard work of providing the education, the resources, the investment recommendations, and really saying, you know, the based on sound fundamental investing principles, how we would recommend someone who has this risk tolerance, this investment objective, this perspective of the world should manage their money.
The one place I see in your offering something that does seem to kind of push you a little bit closer to advice is your reference pies. Like, for example, your retirement horizon pies. And so I'm curious how you see those as similar or different from, say, a target date fund, because a target date fund, if I was going to invest in it, I would go and find there'd be a prospectus and, a set of documentation on it, describe the allocation, everything, glide path and everything else, where your pies are a little thinner, lighter than that. And I'm just wondering how you see those in comparison to one another, and why you don't see them as advice, even though they are kind of recommending a portfolio.
Yeah, so we offer those because we want M1 to be as easy to use from novice to expert. And, there's some people do need guidance or perspective or recommendations. And, the nice thing is ETF portfolios, either in our general investing category or our target date category, are really strong portfolios. It gives you like broad diversification across a bunch of different asset classes allocated to a risk tolerance. And in the retirement style, they get more conservative over time as you approach retirement. And so, for us, it's really just making it as easy as possible to get started, to take an off the shelf solution and contribute. And so that's why we support them and put them in the application. The advice thing is oddly technical in the regulated finance industry, and it really gets to, are we collecting information from you, your age, your investment goals, your perspective, and as a result, recommending a very specific way to invest, either a security or portfolio allocation. And we're not doing any of that. We sort of say, this is just a library of things to choose from. We are not based on your specific needs or circumstances suggesting that as a result you should invest in this. And so it just gets into, for us, we're like our template pies that we offer fall more in the camp of education of, hey, if you self-select into this is what it's trying to achieve. They're truthfully extremely similar to the retirement ones that you mentioned, are extremely similar to target date funds. I think the fantastic instruments, but they're typically mutual funds or not ETFs. They typically have higher fees than just going into the ETFs directly, and then they're harder to manage out if your circumstances change. Where if you want to, hey, during your 20s you're actually a little bit more conservative, and then you realize like, hey, no, I have 40 years to build for retirement, let me get more aggressive. In the target date fund, you actually have to sell out of it and redeploy in another, versus these you can sort of adjust and adapt and fine tune them over periods of time. And so it makes it easier to adjust and adapt as your circumstances change, and you don't have truthfully, one of the biggest expenses in investing is just taxes. And so anything that you can do to minimize trading and realizing unrealized gains is just to your benefit. And so by having direct ownership of the underlying ETFs, we just think it's a better mechanism than owning a big slug through either a mutual fund or ETF that does that allocation.
you've made me aware of something really interesting here, but I want to peel the onion on it so that I understand it. So if I'm an investor and I invest in one of your future target retirement funds, question number one is, if I stay invested in that pie, it's not a fund, it's a pie. If I stay invested in that pie, will the allocation adjust over time without me doing anything? That's question number one. And then question number two is, okay, let's say my circumstances change as you described, and I decide that I don't need to be as conservative as the glide path that is defaulted has in there. And so I'm going to sell some of the bonds and I'm going to buy some of the equities and I change the pie. Does that step me off the path so that I no longer get automatic adjustments?
Yeah. So whatever you set as your pie, your portfolio, is the target that we as M1 try to implement anytime we get additional cash. And so, if it's 50% security A, 50% security B, anytime we get additional cash, we try to do what is most effective to bring you back to that 50-50. So if it's, if you buy it and it's 50-50 and then it changes to 60-40, we put more money in that 40 to get it back to 50-50 and then start adding 50-50 over time. So that's what we call dynamic rebalancing. And what we're trying to say is, there is a portfolio allocation. Anytime money comes in, we're just trying to bring you towards that target allocation. With the target date funds, they do update over time. And so with regularity, they do become a little bit more conservative as you approach the retirement age. And, that is typically shifting from low cap to, a large cap and just getting to, on a risk adjusted return basis, trying to be a little bit more conservative. And so, if you just bought into that target date fund, and let it ride and dividends were reinvested, it would sort of move with the updated portfolio allocation. That always serves as your target, but someone can go in and sort of manually override that. So we don't lock you in. And I think this is where we do differ from a target date mutual fund of, if you said, no, I'm not, for whatever reason, I'm like more bearish than what M1 has, had for international stocks, and I want to pull out of that. You can do that. You can go sell the individual security. You can go buy another, and but the portfolio allocation would remain the same. And so then, if you pulled from one, it would put you underweight, and so we would automatically try to add to that underweight allocation. And so we would always be trying to push you towards the target allocation. The way that you change it more meaningfully over time is you just adjust your allocation. So, really whatever you tell us at any given time, whatever your pie allocation is, we're just going to try to implement that until you tell us differently is maybe the shorter way to say it.
Yeah. Okay. So what I hear then is, if I invest in one of your target retirement windows out there, I will experience the glide path until I change my allocation, change my pie. And if I change my pie, I am no longer on the glide path, and you would no longer make any changes for me, unless what I did was I changed from, say, the 2050 pie to the 2060 pie, in which case then I would still be in the family of glide path managed pies. Cool.
Exactly. You can shift whatever glide path you want to be on, but
right.
Once you sort of take control or take reins and say, hey, I want to adjust the allocations, we're not going to touch it. We're just going to let you do what you want to do with your funds over time. And so there is an aspect of, there are some that we adjust with regularity to match what we are trying to achieve in that expert pie or that allocation.
And just to finish this out, then the way you're different from a target date fund, and I hadn't appreciated this until now, it's very interesting, is that if I were to switch my pie from, say, the 2025 to the 2030 or something like that, that's going to trigger fractional sales and purchases. It's not going to sell the whole fund and buy a whole new fund, which is what I'd have with target date funds. That's really interesting. Thank you. Yeah.
Cool. No, and I think the benefit of that cannot be understated or overstated. I don't know, but yeah, overstated. Because investments over time, you're sort of the house. they typically appreciate over time. So, you invest for any length of time. It's actually like harder to lose money if you're a long-term investor and you put money in various things. So if you've invested in any period of time, the likely scenario is you have a lot of unrealized gains. And so, people like I used to freak out about the $5 commission, $10 commission, but really the more expensive thing is selling a security and having the tax consequences associated with that. And so anything that you can do to minimize the sale of security where you have unrealized gains, you're basically just like, you know, as opposed to handing the money over to the government, you're getting returns on that money until you sell it. So, there's a benefit of just like riding it out. And it's one of the many reasons that we're anti-trading of, uh, you know, one, we think it's just impossible to know with certainty what stocks are going to do on a short-term basis, but then it's just very tax inefficient, and taxes very quickly become your largest investment expense. And so, keeping trading low just keeps your expenses low.
So we do need to disclose, Brian, that we have a relationship with M1. When people come through our site, our link, and they come to M1 and they eventually open up an account, and I don't remember the details, but we get some relatively small amount of money one time. And so that has been a marketing program that you have used to help have people help you reach new markets. When we started doing that, I was thinking in terms of people who would put $1,000 or 2,000 or maybe 5,000. But the first time that somebody called and said, I'm thinking about putting $1 million there, I kind of had to gulp because I wasn't thinking that way. I'm sure you liked if we thought that way, but I just thought this was because you've set this up so that the smallest investor can use your services. But the question does come up about the security of the investments that people have there. What is the risk other than the ups and downs of the portfolio? But what are the legitimate risks of having money with M1?
Yep. So, what I appreciate you referring that $1 million account. So send them our way, and I'll answer the question. But I do think we have many 6, 7, and we even have 8-figure accounts on the platform, and so I do think there's this, um, you know, belief that because we're a fintech platform, we're for the ultra novice or small dollar figures. We have many people who are built up very sizable sums and have their entire life savings on the platform. So, and M1 manages a little over $10 billion. And so we're a fairly substantive financial institution at this point. Man, I would absolutely love to say zero risk whatsoever, but compliance would I would get slapped on the wrist for that. To me, I don't think that there's any more risk than investing with a larger financial institution. One, we are a mid-sized financial institution with over 10 billion on the platform. We've raised a lot of money and we're well capitalized. So, from a just business perspective and financial perspective, we have financial strength. From a regulated entity perspective, we are regulated just like every other regulated financial institution in the country. And so, and truthfully, in the broker dealer realm, there's about 5,000 what are called introducing broker dealers, and then there are about 200 clearing broker dealers. And clearing broker dealers have significantly more stringent regulations because they're actually holding funds. M1 falls into that set of 200. So we are regulated to the highest extent possible in the broker dealer realm. And the banking products we are working with, M1's not a bank, but we use a bunch of bank partners, one of which I own. And so these are regulated financial institution, regulated banks, and man, do they regulate and audit us on everything. And then you have additional insurance on top of that. So on the broker dealer realm, SIPC is what covers it, and that's should the broker dealer have financial issues or do anything that's fraudulent. all funds are default insured up to $500,000, and 250,000 of that can be cash. In the FDIC banking realm, it's 250,000 in cash, but we partner with a group of 20 banks out there. So we actually provide $5 million of FDIC insurance. And then you just get to security best practices of, and it's the same thing that I was talking about with the number of trades that we do. By starting in 2015, we were able to deploy sort of the best practices in digital technology, digital security, cybersecurity, where truthfully, like the thing that terrifies me about the big banks is they have 300,000 employees, and it's like that's a city, and no city doesn't have bad actors and criminals and people doing all this stuff. And so to me, it's this is where funds are saying I have 100% of my money on there. We have like my entire family has most of their money on there. I want to institutions in America. I think it's a combination of the regulated nature of it, the insurance that we provide, the cybersecurity, the way that we approach things, and our financial strength. And so it's not one single thing that guarantees everything, but hopefully that provides a picture of we just take, we are forced to take being the custodian of customer assets very seriously, and then we just think it's an ethical obligation to to care about your money like almost as much as you do.
Great.
You mentioned earlier, Brian, that you have these fixed trading windows through the day, and I think anybody who's on the platform is familiar with those. But one of the questions that comes up to me sometimes from our listeners is, does that disadvantage me as an investor? And so what does what's your view of that? Does it disadvantage an investor? And what does M1 do behind the scenes to make it so that that isn't a disadvantage, the fixed trading windows?
Yep. So the fixed trading windows are somewhat a artifact of circumstances that when we started to build the fractional shares, we just had to compile all the shares at one time to go to the market because nobody supported real-time fractional share trading. And so this was, a little bit of how we built it from the beginning. And then a lot of it aligns with our perspective and philosophy of, man, we want to make it easy to enter and exit and not put handcuffs, but it again gets to the this investing versus trading mindset of um 5 years from now, like no one remembers the trade that they did at 10 a.m. versus 11 a.m. So for us, it's really about getting into the investment, the portfolio allocation, and we are taking a little bit more of a perspective of want to enter at market price rather than have any extra knowledge or extra emphasis of, is that correct plus or minus a penny or two throughout the day. We just think that that's a hard thing to do. So, I'm saying all this to really not, we absolutely do the things to get market price as time of execution, which I'll talk a little bit about, but we try to de-emphasize the importance of, hey, I bought at 9 a.m. and then at 10:30, it was 0.5% higher or lower. And trying to say yes, it would have been better, but we don't have crystal balls that know everything. And, the price at 8:30 is, sometimes you're going to win, sometimes you're going to lose, and it nets out to be an average if you are investing over long periods of time. In the background, we get market prices and our orders do not move the market or change the price. And in the broker dealer realm, we have the duty of best execution, which means that there is a open market. There's a very transparent market that has a bid and ask spread associated with it. And we have an obligation to get that or better. And so, that's the only place that we can execute. And so we either do that by buying or selling on the open exchanges of NYSE, NASDAQ, or BATS, or selling it to these, wholesalers of Citadel, Jane Street, Virtu, and saying that we have to get, what is the best price quoted on the market or better. And truthfully, we very often get better. And so we're doing things to manage that. And then we are concerning ourselves with making sure that the orders aren't large enough that they sort of like eat through the supply and demand of the shares at any given time. And so we're doing things to manage that in the background so that we aren't actually moving the price of the market as we trade. And then, I'd say the final thing, this is where we actually get a lot of critiques, but we're doing, we have requirements that certain securities have to have enough liquidity for us to support them so that we don't move the market. And so very small, penny stocks, very small ETFs that don't have a lot of trading volume, we just say we can't support that in an automated fashion because if we go to market, there's a chance that we eat through the demand and we can't, sort of stall the automation associated with things. So again, it's a combination of a lot of things. We try to de-emphasize the importance of point in time trading. At point in time trading, we are ensuring that you get market price or better, and then we are doing some things to ensure that we do not eat through the liquidity of any given security and are doing sophisticated things in the background to ensure that that happens. And so, people, if you trade on M1, you get market price or better at time of execution.
You didn't say it in your answer, but Paul's probably familiar with this. If you take a retail investor and you ask them to go trade in or out of any equity in real time, there's a lot of emotion, right? Just, oh, it's going up. No, it's going down. It's, should I do a limit order? Do I do a market order? Oh man, I lost all this money because I didn't do my transaction an hour ago. And I think one of the nice things about the approach that you take is that all of those questions go away. And I think most of the academic data says that it was a waste of time anyway, right? People can't time the market. There's a huge benefit to just removing the emotion from the transaction. Yeah.
100%. I am the personal finance nerd. I geek out on all the literature and academic. And so, totally agree. All the literature would say, but for like three giant firms that deploy billions of dollars, like trading is an unprofitable, business. Like unless you're like Renaissance Technology or Citadel, like those are the two people that should be trading more frequently and making money by it. I also think of it as, what would I describe to my sister who's as smart as I am, but just not as interested in finance. And there's no part of me that would say you should trade more. It would be like if you're buying and selling, like you shouldn't own it to begin with. There does need to be an understanding of what you own, why you own it, relative value. I do think that's important. And this is not to say you shouldn't ever enter or exit investments, but it's you know, no part of your decision should be because it went up or down on a Thursday. Like that should be, not the relevant part of your investment decision. You should be thinking of relative to how I think this is going to do over the next several years. Is this something that I want to have an ownership stake in or not?
And since you know all of the shares that need to be bought or sold at this particular moment in time, I don't know that I heard you address the idea of crossing orders. Is that just naturally happen? Or how do you deal with that if you have that ability to cross?
You're asking a great question. This is regulation that has changed that has made it significantly more difficult to cross shares. And so, yeah, we would love to, it's called like internalize the order flow and match them and do it at the midpoint, and it would be to the benefit of all of our customers. This is one of the areas where it would be like nearly impossible to do without running afoul of regulations. And so
Oh.
we end up sending it out, and oftentimes we send it to, a market maker that they cross it and make the money, and we could have given that back to the customer. And so the different regulations have some unintended consequences of not anticipating this sort of bulk ordering and being able to internalize the flow across various people.
I don't think that we've asked you to briefly talk about you did mention that you are in many different markets supporting people. but you have a money market rate that is competitive with most all of the ads that we see on the internet. Are you allowed to say, for example, what you are paying now, or is there a problem with that?
Nope. We are paying 4.5% right now. And, we were paying 5% until the Fed lowered interest rates. And so we do try to always be top of market, but it's indexed to whatever the effective federal funds rate is, which is the overnight rate that the Fed sets.
And leverage for margin. I've seen your rates. They're very competitive when I've seen them. I'm not using leverage or margin, but I'm always impressed that they look to be very competitive. Is that my imagination, or are you in fact amongst the lowest cost?
We are absolutely amongst the lowest cost. And so the current base rate is 6.25%. And so we really do try to price that at federal funds plus 2%. And so, for a couple of years in our iteration, it was 2%, it was 2.25%. So, that was the more exciting days of leveraging the portfolio or getting access to liquidity. But we do price it. We are, I think versus the big player. This is where get frustrated of some of the big players like a Schwab, a Fidelity, a Ameritrade before they got wrapped into Schwab or E-Trade. They're charging 12, 13, 14%. And so it's absolutely wild what they're charging for what amounts to fully collateralized lending. We try to be lowest in the market, and I would say it's really us, Interactive Brokers, and Robinhood at sort of lowest in industry rate.
You described low liquidity being one of the things that would prevent you from picking up an ETF or offering having it be part of your offering. One of the listener questions we've gotten is, how do you decide which ETFs that you offer? And specifically, they were wondering about the iShares LifePath 2040 ETF as an example. But just in general, can you speak to that? Like how you decide what's in, what's out, what you offer and what you don't?
Yeah, the largest factor by far is what is the trading volume on a day-to-day basis. And we both look at aggregate, rolling history, and then sort of like how it spikes on a day-to-day basis. And so that is, you know we have a very complicated process that goes into a bunch of different scoring, and have different committees have to meet on this to whether we support it, because there is an aspect of once we support it, the second one we pull it, or go to, hey, we only sell this, as opposed to being able to support it in full sum. So not familiar with that ETF that you mentioned. My guess is they're slowly building the assets. There's not enough trading volume, or the trading volume is very spiky where, hey, if it's a Monday, it's fine, but if it's a Thursday, it's not. And so we are really doing that to not, and it's to this earlier point of run afoul of the regulations of, we don't want to move the market when we place trades. And so we need to be able to have confidence that given M1's volume, we can support that volume in our trading windows.
You have recently added a platform fee for folks. You want to explain how that works in terms of how many different accounts you could have that would be covered by that one platform fee?
Yep. So, we had prior to the platform fee, we had two different versions of M1. So we had a basic version and then a paid version that we called Plus. Plus was $100 a year, 95 a year, or $10 a month. And you really got the basic version is a free platform, but we sort of, made money on cash balances. If we didn't pay you on cash, we gave you less in credit card rewards back. We charged higher rates on margin. But then if you paid, you got better rates across the board, better access, more tools. And it just got into a little bit of a complicated fashion of, trying to sell a platform that's worse than what we could offer, and then, trying to sell a platform that's better than what we could offer. And so we just reduced that and said, all we're going to market with is our best offering. So, that's every single cash account or high yield savings account went up to the 5% or 4.5%. We knocked down all the margin balances to the lowest that they could possibly be. And then we instituted if you have $10,000 on the platform, or we offer personal loans. If you have an active personal loan, 100% free. So you get the best rates, you get everything, so if you're using it with more than $10,000, it's free. If you have under $10,000, it's $3 a month or 36 a year. And so the things that add up to the 10,000 is any money in your earn account, which can be a high yield cash account or a high yield savings account, any account in our invest vertical, which can be a taxable brokerage account, it could be a Roth IRA, it could be a traditional IRA, or you have an active personal loan. So our hope is we make it as easy as possible to get it for free, and not relatively small amount of money of $3 a month. And that's really just to be able to support the product and platform, $36 a year for accounts sub $10,000.
And what about for people who have multiple family members, a husband and a wife who have their IRAs? Are they combined into that 10,000, or are those going to be separate accounts because they have different social security numbers?
Probably more of a limitation of our system. We do it by sort of logins, but then with support, people reach out if there is a family. I like yesterday, I just granted free access to someone who is the kid of someone with a large account value. So like we'll be super accommodating to situations like that. We're just trying to, truthfully, on these smaller accounts than $10,000, we're just trying to break even. We're just trying to cover the bills. And so, it's not to dissuade usage or anything. It's really to just align incentives of people that use M1 as their financial institution. And, for sums of money, we'll make enough on that. We can support it. And if there are people who fall into unique circumstances for various reasons, we are accommodating, but we do those on a case-by-case basis versus being able to link it up in the background.
Since Paul mentioned multiple accounts, we had a listener question on that. Is there any functionality in M1 that helps me keep my portfolio allocation balanced properly across multiple accounts? My wife and I have, for example, traditional IRAs, Roth IRAs, inherited IRAs, and brokerage account, and it's hard to implement a comprehensive strategy. I think of that as an asset allocation that considers all of them. Is that something you've looked at, or?
Yeah. So the answer, yes, we've looked at it. Unfortunately, the answer is no, we haven't implemented it, and it's absolutely something that is higher in our priority queue. Like as we add, to the earlier point, insights and analytics and guidance, being able to take a more comprehensive view that, M1 has, we had to build up all the products, and as you build them, you don't think about all the ways that they are seamlessly tied together. And I would say now, given that we built all the pipes and plumbing, like that is our next focus is how do we give a holistic view of someone's finances, whether it's in a specific domain like invest, or if it's across domains of earn and borrow or invest and spend and, whatever it may be. So, the unfortunate answer is no, we don't have it, but I would say we don't have it yet. Something that we're.
Not yet. Not yet.
So I know we got to go in about a second here, but I have to ask. I think about the Bogle story and what he faced in his early creation, and it was called Bogle's Folly, and people thought it was going to fail. And how much of that did you run into when you came up with the idea of building M1? Was everybody, yeah, you go do it. This is great. I don't see any problems, or did they see nothing but problems?
Both. The quote that I always use is entrepreneurship, the highs are high, the lows are low, and they're 10 minutes apart. And it is, there are times where, like, especially in the early days, it's, oh man, we're going to take over this, financial industry. We're unstoppable. And then 2 seconds later, something happens and it's, why did I leave my job? Like, I'm an idiot. This thing's going to zero. And so like, there is a, uh, like you're when you start, you're just so tiny that you get whipped back and forth so quickly. I think now that we've gotten a little bit larger, more heft, more substance, and have more predictability associated with it, it gets a little bit more tempered. I still have, sort of this Dr. Jekyll, Mr. Hyde, perspective at times with how things are going. But no, we there are people who are, I think, see the future and really take the perspective of, man, personal finance is not solved. This is something that the tools today can be way better than the tools 10 years ago. The tools 10 years from now are going to be way better than what we're experiencing now. And so someone has to build towards that. And, someone with perspective and vision and energy to do that, like that's the only way that it's going to happen. And then there are a lot of people who are like, good luck taking on giants, and then there's a truth to that of Schwab's and Fidelity's budgets are 100x, 1000x us. And you do run into a scenario where people would rather use a subpar platform or get subpar rates because they get like the trusted brand name of Chase attached to it. And we have to that's just like the practical reality that we're in. So it's yes, all of the above. We get enthusiasts, we get detractors. Was in the early days, we get it now, and just something that we have to. Our goal is to set high expectations and then even try to beat those.
That's great. Good luck to you, Brian. We've really enjoyed working with your organization, and I think you've got something really good going on, and we're anxious to see what comes next. Chris,
Amazing. No, thank you for all your support, and yeah, super
you're
fantastic
welcome.
to talk.
Is there anything else we should have asked you about, Brian? Anything else you want to tell us?
Oh, do you have a sister or brother that are starting a new company somewhere we should know about?
No, I need to encourage him to. If I would bring him into M1 to start some things internally. No, I think we covered a lot. Like to me, I think we've built an incredible amount. I think we have a very strong platform. I am extremely excited about the things that we're working on now, and I think that M1 will only continue to get better. And so, hopefully, you guys are get excited about what we ship. Your users are excited about what we ship, and excited about where M1 goes from here on out.
This has been really helpful. Thank you very much for spending the time, Brian.
Absolutely. Thanks so much.